Speaking of the broker moves, Jeffrey's seeing some positives in CSL's acquisition of Varmex for 117 million US dollars. It estimates annual peak sales for the new product at around 240 million US. The broker also saying the new agreement is evidence of the biotech's renewed focus on R&D and adds CSL and the global plasma industry a potential to continue strong growth. Morningstar expecting long-term earnings growth for Qube, saying their logistics company has built a dominant position in port and rail haulage logistics. Qube is also developing the Moorebank precinct, which is set to become the country's largest inland intermodal terminal. And weighing in on IDP education, Jeffrey's flagging a lower amount of downloads for its English tests app, but has seen higher traffic on the website. Jeffrey's saying IDP is outperforming peers, holding 16% share of website traffic. Well, our next guest is talking about why Australia needs a framework for intergenerational certainty. Felipe Arujo is Generation Life Chief Executive. He joins us now, Felipe. Good to have you on. AusBiz, welcome. So, certainty or the lack
Thank
of
you.
it. What is it you're looking at in terms of perhaps why that leads to difficult decision making?
Yeah, no, look, first and foremost, thanks so much for the opportunity to be joining you today. Look, at Generation Life, we're incredibly proud to offer it to Australians and every single financial advisor, not only an investment bond solution, which is an incredibly tax-effective way for Australians to accumulate wealth and to transfer their wealth to the next generation, be it family-related or not, and I'll go into in a bit of detail, as well as our lifetime annuity, which first of its kind, it's our first investment-linked lifetime annuity in Australia. Not only has it got an phenomenal emotional outcome, which is for Australian retirees to live the retirement that they ought to have, but also because governed by the Life Act, it does have a potential estate planning benefit, not just by increasing the size of the account-based pension, but also if there is any applicable death benefit, it will be paid to a beneficiary of choosing. But why we're so focused, why we want to completely transform the way that Australians transfer their wealth to the next generation, is in recognition that the demographic shifts in Australia right now are one that advisors have worked so hard with their clients to build their wealth. We have never had a wealth transfer in Australia to the vicinity that we're about to have. In many ways, Australians and their financial advisors have absolutely made the most of the structures which have been available to date. The main one being superannuation, being in the form of SMSF, so purely on a super form. But it is no longer the vehicle that should be used for that transfer of wealth. And with it comes a huge opportunity for financial advisors to better educate their clients around the alternatives. And that's where we see the world of investment bonds sitting perfectly as a perfect intersection of a fund management business, as well as obviously having the life license that enables us to not just offer a tax-effective structure, but one that can facilitate that conversation between advisors and their clients around which assets they want to transfer to which beneficiaries. And we go beyond a Generation Life by not just educating advisors on the benefits of doing and having that early conversations, but also in the features that we have built. One that we're incredibly proud of identifies a very effective way to limit or to put restrictions in place on that transfer and to dictate a future dating time or upon passing for that transfer to occur.
All right, so just before we get in further into investment bonds there that you're offering, you're saying in the present system there is that danger there. Particularly we've got that ongoing debate about the Division 296, although the government is clearly reconsidering that. Negative gearing, taxation in general, you're saying particularly if you hit that 30% threshold, you are in danger of seeing your capital eroded. So where does the use of investment bonds come in?
And I think that's a phenomenal question. Yes, Division 296 has highlighted the need for an alternative structure beyond that of superannuation. There are broader tax reforms being discussed at this point in time by the government, be it family discretionary trust, be it the continuing tweaks to superannuation. Yes, Division 296, it surprises us that there's been so many discussions around it. It's been around since 2023, but clearly government hasn't landed on a position that they're happy with and confident that they will be approved by both houses. What I think it's clear, and it's become very clear throughout this process, is that the government sees that a need for change to bring more equality into the system. And that's where the world of investment bonds can provide a certainty that is not present, particularly in the world of superannuation. Now, there's a few reasons for it. Perhaps the largest one being the size of the superannuation pool at this point in time, and the fact that, needless to say, because of the concessions available within the superannuation system, it becomes very tempting for the government to make tweaks to it to increase their bottom line. I guess where the world of investment bond is benefiting from that attention to superannuation is the government's Off the Life Act has ensured that the structure is a very stable one. Now, for those who are unfamiliar with the world of investment bonds, it is actually a structure that precedes the world of superannuation as we know it these days, right? So, and by that, I mean the world of superannuation as a defined contribution scheme, particularly since 92, which has had superannuation guarantee contributions implemented by law. So the structure has been around in Australia for a very long time. It's sat dormant, in our view, for way too long. We came into the space in 2017. We've rebranded a company that had been in place since 2004, issuing and specializing in investment bonds. And since 2017, we've had a firm mandate and a firm vision at Generation Life to reinvent the structure of investment bonds, to augment the benefits, to identify the true benefits of the structure, and to address the misdemeanors. And believe me, there was a lot of wrongdoing. There was a lot of misdemeanors within the world of investment bonds. They were a structure that had very few investment options. These days, Generation Life has almost 80 investment options within it. They were a structure that was very expensive. We have reduced the administration fee. We have a tiered fee, and on average, most of our clients are paying less than 40 basis points, which is far more cost effective than the structure has ever been. We have added new features, particularly in the world of estate planning, to facilitate that transfer. That transfer that I mentioned before that can occur without restriction is new by Generation Life, and all governed by the Life Act, right? And this is where I really like to, when we're doing a side-by-side comparison between the world of investment bonds and the world of superannuation, is that unfortunately the notion of changes to superannuation has become somewhat part of our vernacular, and we're all used to constant tweaks to superannuation, where the world of investment bonds has been a very stable structure with small changes to it to align it to the world of the Life Act, but overall a very stable structure.
So, bottom line there, you designed the 10-year investment bond, if you like. So you're saying this is most tax effective for those on a marginal tax rate that's higher than 30%.
That is spot on, right? So the world of investment bonds, we pay tax. When do we pay tax, actually? That should be the first question that I answer is, we pay tax on realized capital gains and income, right? So we don't pay tax on unrealized capital events. One of the controversies behind Division 296. We are pegged against the corporate rate, which means that we pay 30 cents on the dollar on every earning that we have. What we do at Generation Life that is slightly different and unique in the marketplace is that we can control the assessable income by flexing the benefits of the investment bond structure. We can reduce that assessable income in a very simple manner, which is through income management. Now, anyone can do that. Most basic way to implement income management is by franking credits. We can reduce the assessable income. More complex is by maximizing the benefit that we have by operating out of a revenue account, not a capital account, which means that a capital loss in income is treated the same in our world, so we can offset a capital loss with income. That reduces the assessable income, that increases the after-tax results that we've got at Generation Life. We'll always pay 30 cents on the dollar on the earnings, but for us, where we specialize, where we invest a significant amount of our capital, is to ensure that at any point in time, our systems and our people are offering and playing within the rules of the Life Act to minimize how much tax we're paying, minimizing that assessable income.